Hi, so I'm Jared Schlosser. I co-run our hotel originations and lending, as well as our CPACE division for Peachtree. I think today it's all about cash flow. It's hard to underwrite any sort of pro forma growth unless there's a real story there. So lenders are focused on cash flow, and if you have, a 13 debt yield or higher, you qualify for generally permanent debt, CMBS or life company, or even bank takeouts. If you don't, then it's everything below that, which generally falls to private credit, i.e., us. I think that it's been all over the board, right? Depending on kind of what each lender's risk threshold is. But the biggest trend I'm seeing is nobody knows how long rates are going to be for an extended period of time. So every borrower is looking for flexibility. So they may be willing to pay a higher price for something that has shorter yield maintenance on it or less prepay. And borrowers are hesitant to lock into longer fixed rate debt than they used to be. We do, both fixed rate loans and floating rate loans, and it seems even on our fixed rate stuff, borrowers are trying to find as much flexibility with it as they can. So I think that's the biggest trend. We're still getting to 70% LTC, LTV. Sometimes pushing up to 75, sometimes pushing down depending on what our underwriting is. The banking market is probably closer to that 50-55% on average. So, still a different world that we're playing in on our side versus traditional banks. I think I always say in a volatile market, get ahead of it, get ahead of the maturity, get out, talk to people, whether you're talking to us or people that we compete with in the space. I think getting out there early right now is important because you just don't know what's going to happen. Particularly, we have an election coming up. We have a lot of volatility in terms of what will the Fed do? Where will they cut rates? Where are they going to go? Are we higher for even longer than we anticipated? And so you have players jumping in and out of the market, so liquidity is going up and down. So the sooner that borrowers are out in the market looking for their refinances or their construction financing, and the more put together their packages are, the better.